Hi everyone. Thanks for your patience. I've been standing in front of that computer for the last 10 minutes while it loaded. Look, I hope you had a nice break. I hope it wasn't too busy for you in terms of some of your assessment. I know you've got one for us. I'm getting some good questions. That's fine. I just want to talk about the assignment just a little bit. Had some really good questions in the workshop today, which kind of prompted me to, share some kind of thoughts and ideas and things like that. So, just to reiterate, one of the benefits of doing something like this is that we don't have any preconceived ideas as to what the right time slot is for this game. I couldn't care less, right? I care because you guys have got some time and resources and energy invested in it, so of course I care. But I don't mind what you argue, is I guess a more precise way of putting it. Ordinarily, when you're arguing for a particular point of view, at least part of that involves you justifying or at least mounting an argument as to why your point of view is better than the status quo and the other alternatives. How you do that and the extent of attention you attribute to that in terms of resources and in terms of space and words and things like that is up to you. We don't have any kind of necessary formula in terms of how much time did you spend on this and how much time did you spend on that. We will be looking for strength of argument. We'll be welcoming and embracing the idea that you guys are probably going to go about this in slightly different ways, which makes it really palatable from our perspective because we don't have to read the same thing over and over again. And I don't mean that in any bad way. I mean that we genuinely look forward to reading some of these because this is an opportunity for you guys to show what you've got. If you think there's some, unique ways of getting data for the purpose of, mounting an argument, go for it. That would be my general encouragement. I'm getting a lot of questions that start with should we, and the answer is no. Do we have to? No. Do we need? No. Right? You don't need to do anything. There are some structural, do you need to go about this in a rigorous and robust fashion? Yeah. Do you need to give some thought to it? Yep. In terms of do we have to include? No. Right? There's some formatting kind of suggestions that we've made for you, but rest assured, I did have another good question, and one of the questions I was asked today, what's this got to do with accounting? I'm paraphrasing a little bit, right? But what's this got to do with accounting? Because we might have a shortage of financial numbers in our case. And I'm not quite doing the question justice there. Really good question though. One of the skills that I would love for you to take away from a subject like this is at least an appreciation as to how to compile a business case. So not all of you, or maybe not many of you, are choosing to major in accounting when you finish this, but you're doing it as a part of another degree of some sort. Regardless of your major, you will, I suspect, be involved, or the likelihood is very, very high that you will be involved in the preparation of a business case at some stage. And if you at least have some sort of memory of doing it here, some sort of insight as to the ways in which you might put it together, you're at least a little bit down the path of developing some relevant knowledge for whatever course and whatever journey, wherever your journey takes you. So don't underestimate the relevance of doing it. I'm not asking you to do it just for the sake of it. It's a really worthwhile skill and an applied skill for you to take away. But other than that, we're embracing and looking forward to the fact that you guys are going to probably do it in slightly different ways. And that's cool as far as we're concerned. All right? Feel free to keep the questions coming. If you've got something that you want to raise, come and tell me in the break. And if you've got something that you want to raise that's relevant to everyone in relation to the assignment, let me know. I'll talk about it as we come out of the break. In terms of what we've got in store for you for the rest of the semester, remember earlier on I mentioned the idea of a very short MYOB exercise. We're going to make that available in the coming days, and you will have a bunch of time to do it right till the end of the semester. It will probably take you about 4 hours to do, and there's 5 marks up for grabs. All right? So it is as unintrusive as it gets in terms of 5 marks. Think about it in terms of a compliance exercise. It's 5 easy marks. Okay? So there's that. Other than that, there is some indication that, preliminary indication that our exam will be in the middle of the last week in the exam period. Now, this is preliminary indication only. I don't have any say as to when the exam is, but the information I have so far is that it looks likely to be in the middle of the last week. Okay? Now, some of you are kind of looking at me and sending me, I'm getting negative karma coming my way, right? For every negative karma bit coming my way, just know that that means that I have about 4 days to correct them before results are due. So, would I like an early exam? Yes, I would. All right, so I share your pain. That's my point. We're all in this together, and we do get notified. I got notified at the end of last week, so my sense is that you will find out in the coming days. All right, but that's the information I have. I'm a bit naughty. I mean, we're taping it, so I'm probably in trouble. But anyway, we're a bit naughty for sharing it, but that's the preliminary information I have so far. Okay. All right. I think we're all ready to get into it. Other than that, reminder that there is no classes tomorrow. There are no classes tomorrow. So I put a message up. It was a little late. I meant to do it on the weekend, but there are no classes. I know one additional thing. So in the coming days and weeks, I will start putting up some previous exam questions for your practice and your enjoyment. Maybe I should say your enjoyment and practice. Please, I will ply you with more information about the upcoming exam in due course, but I think it's safe to say that you should be starting to lift your eyes now and working out in the unit in subjects like this what you know and what you don't know, and start to kind of at least giving some awareness for what you've got in store for you. I will provide you with full detail, well, almost full details on the exam in the final week. There's no problem there. But I think it's safe to say, and it's reasonable for you to look for a benchmark type collection of questions that'll give you some insight as to the nature and difficulty level of the questions you can expect. I will certainly do that. Okay? And you can expect them to start appearing on the LMS in the coming days. Okay? All right, so with regards to tonight, bless you, I want to look at the other side of the balance sheet tonight. So we've been talking a lot about assets. I want to look at liabilities and equities. There's 2 chapters involved, so but just be conscious that I'm going to pick the eyes out of the relevant chapters. So if you think there's double the reading, there's not double the reading. I'm literally going to be really parsimonious or really specific about the areas of each chapter, because I don't expect you to read, 40 pages times 2 chapters. Okay? But I will be pretty specific about the important parts of each topic as we go. All right. There we go. Look at that. So what we're looking for, or a common theme across tonight, is that we're exploring how organisations finance themselves. And broadly speaking, there's a mixture or a choice between a balance of liabilities and equities in financing or funding a company's assets. So that kind of sets up a few specific learning objectives. And in terms of, in keeping with what I've been doing so far, there's a bunch of learning objectives. I will, when I set the exam, I will go back and make sure they are specifically mentioned or specifically included within learning objectives within a specific week. Okay? So when I suggest to you focus on these ones, or these ones are new for this week, I don't put in learning objectives just for the sake of it. That's all I'm saying. So explain the differences between liabilities and equities, and evaluate debt and equity as alternative forms of finance. I don't want to dwell too much on this, but I do want to explore the reporting implications, and particularly in terms of measuring performance. Whether you adopt more debt or less debt, and therefore more equity, will have direct implications for how profitable you look. Right? But we'll explore that a little bit further. Common types of non-current and current liabilities, and explain the implications of each. In doing so, we'll have a look at a fairly recent court case involving a Big Four accounting firm as well. One specific type of liability is assets. Is leasing. I read leasing key assets there, right? So I conflated some leasing, and we're going to look at those. So in terms of the first page, 1 and 3, I'll draw your attention to. We're going to look at specific types of liabilities. I'll draw your attention to these ones, contingencies and provisions. I do so because they're slightly different to the liabilities, the rest of the liabilities that we're talking about. We do a few ratios, and then from number 6 onwards, we finish talking about liabilities, and then we start talking about equity. Okay? So in terms of relevant ones there, it's probably 4 and 7. Now, mind you, all of them are important, but these are the ones that are new. Okay? So when I say, liquidity ratios, really I'm going to show you 3 or 4 of them, and there's probably only one that you haven't seen so far. Right? So while I show them all to you, there's only, I'll specifically mention one. I'm going to finish off with some additional transactions. So we look at the recording of share issues and why a company might do it, and what the general, the overall economic significance or consequences of a share issue are for a company. And then we'll have a look at some of the other stuff that you'll typically see. So share splits and dividends, cash and share dividends, and why might a company issue them and undertake them and things like that. And we finish off with, some more ratios that we might use to understand how a company is performing in terms of its dividend and its interaction with the market. Sorry, both important. All right, so let's get into it. So I guess the first takeaway, or the first point I'll encourage you to think about, is that the mix of liabilities and equities that a company has is crucial, right? A company's capital structure is crucial. Why? A few reasons. There's no such thing as an ideal capital structure. Some of you might know people, or some of you might, have colleagues or work for a person or people, etc., that might have a view as to what the ideal capital structure for a company is. But there is no ideal capital structure for all firms over time. Why? Because the capital structure that might be appropriate depends on a bunch of things. It depends on interest rates, it depends on cash flows, it depends on profitability, it depends on access to other forms of debt, availability of other forms of capital, etc., etc. Depends on many factors. What is clear, though, is that on the surface of it, or all else being equal, additional debt, to the extent that it is associated with additional interest payments, is generally associated with more risk. Now, I'm going to unpack that a little bit, and I don't want to make this into a finance lecture, but put simply, interest is typically an obligation that is non-negotiable. Creditors can enforce bankruptcy if circumstances don't go the company's way, and it's in that context that extra debt is typically associated with more risk. All right? Now, I'm going to kind of muddy those waters in a little bit, but that's our starting point. And you can actually see, though, as well, that company share ownership also provides people with various benefits and is probably more attractive than ever before. It's easy to own shares now than it was years ago. Equity ownership is a popular form of finance. There was a study by the Australian Securities Exchange in 2014, and according to them, this seems a little high to me, but according to them, 36% of all adults in Australia own shares. Right? 36% is a lot. But the point being that share ownership in countries like Australia is really high. Why? Well, there's a few notional benefits that you get as a shareholder. So typically, and in theory, I guess, you get a voice in the management of the company. So you can go along. You buy shares in BHP and you can typically go along to the annual general meeting and ask them questions. Right? Generally companies are required by their constitution to put certain issues up for vote. So voting of directors, remuneration package, reappointment of auditors and things like that. And there's all sorts of proxy mechanisms that companies use to vote and things, etc. But actually you can go along and vote. And there's actually people that buy a few shares in a company and take that as their life's mission to then go round and appear at the annual general meetings and cause a stir. I actually got on a plane one day a few years ago and I was going to Adelaide. Has anyone come from Adelaide? Don't worry, I'm not going to talk naughty about Adelaide. But I got on, and you know, I don't know what you guys are like, but when I get on a plane and you sit next to someone, I go, how you going? And they go, good. How you going? And I go, good. And we're done, right? That's it. Okay, and you put my head. So I got on one day and I said, how you going? And this guy goes, well, not very good actually. And I thought, oh no. Anyway, it turned out that he was one of those guys that he owned, 50 shares or 100 shares in a company, and he just goes around and he goes to the annual general meetings and he asks them questions. And he started talking to me about it, and I thought, oh no. And so I'm listening, and I thought, he paused at one stage, and I thought, you beauty, there's my chance, and I put my headphones on, right? He tapped me on the shoulder because he hadn't finished. It's really awkward. Anyway, but the point being that you do get a voice in the management. You get access to a future dividend stream, whether or not they be cash or shares. And in theory, now this doesn't always happen, but in theory, if the company is wound up, you get a residual or a claim on the assets that are left over after all the debt is paid. But I wouldn't bank on that. I wouldn't rely on that bit because typically if a company is wound up, it means they haven't got enough money to pay their liabilities, and liabilities rank before shares in terms of return of capital if a company's wound up. As we'll get to a little bit later as well, there are some benefits of issuing shares for the companies. And those benefits typically involve the opportunity to conserve cash, the opportunity to have dividends which are discretionary instead of by obligation. So there are benefits and downsides in both ways, but I'll come back to that. All right. So where do we start? So in terms of current and non-current liabilities, all right, so we've prepared a bunch of balance sheets already, and I think, if I said it's important to classify liabilities in terms of their currency or non-currency, and sometimes this can be difficult, you probably would roll your eyes at me. Let me tell you a little story. It happened, it's about eight or 9 years ago now. So Centro Properties Group. So this is Centro Properties Group's share price at the end of 2007 into 2008. Okay, this is at the back of your pack. All right, so don't stress. I'm just going to talk a little bit about it, then I'm going to come back on track. Okay. So the share price at one stage for this company was $10.02. So close on the 2nd of May 2007 was $10.02. As you can see, by about November 2008, it was about 2 cents. All right, so $10 to 2 cents in the space of just on a year. All right, what happened? Well, what happened revolved around the classification of its debt. In the June 2007 accounts, the company disclosed it had no short-term debt. 0 short-term debt. Okay? That was later, and this is all on public record, in December of that year, the company admitted it had incorrectly classified some debt as non-current when in fact it should have been current. $1.096 billion of debt was classified as non-current, and it should have been current. I'm going to talk to you about the circumstances in a minute. That was later, in June the following year, upgraded to $2.61 billion. So $2.61 billion was classified as non-current, and it should have been classified as current. Okay, what does that matter? It matters because at the time, if the company had have classified that as as current, there would have been a shortfall in terms of working capital, and working capital would have been negative by about $500 million. Right? This sent, so people dealing with the company would have identified a problem then and there, rather than it persisting for another 12 months. This is what essentially drove the company into liquidation, and it was since purchased and things like that. Centro Property was a company that developed shopping centres and had an extensive array of shopping centres in their portfolio. So what happened? Well,
The reason why it was classified as long-term debt is that the company typically refinanced. They had short-term bridging finance, and they had planned to refinance on a longer-term basis and didn't get the deal done by the time the year end occurred. A couple of things, interest rates went up, the availability of debt, the party on the other side didn't finance it immediately, such that by the time the accounts were signed off at June 30, 2007, they had this short-term debt, but they classified it as long-term debt. Right? 6 non-executive directors, no penalty. CEO, $30,000 fine. CFO, penalty. Class action May 2012, $200 million settlement. PricewaterhouseCoopers were the auditor on the job. So it's not some backyard single audit firm. All right? If I had said to you at the start of this that, it's sometimes difficult to classify liabilities as current or non-current, you possibly wouldn't have believed me. It all depends on the requirement and the date as the balance date to what is the technical and clear and formal date which the liability that you have must be settled. And at the time the accounts were signed off, that date was within 12 months. Right? So, getting back to where we were, the key message is that financial statement users do want to know whether an entity can meet its obligations when they fall due. So, therefore, the classification of liabilities as current versus non-current is absolutely critical. All right. So, that said, we've dealt with a few current liabilities before, an obligation that is, we expect to settle within 12 months. Typical examples, accounts payable, revenue received in advance, etc., etc. We've done those already. Okay, I think we can tick those off. Notes payable, we're going to come back to those. Most notes payable or debentures that we will cover will be longer term, and that's what we're going to explore a little bit later on. Right? So typical examples of current we've done. One example we haven't done that throws up a couple of different issues is payroll. Right? So some of you might be working in an organisation already, some of you, and you get regular payment. There'll be some amounts taken out of the regular payment. You'll contribute to some funds or some pension funds, etc. This all has implications for the company concerned. Right. So, when many of us get paid, and myself included, when many of us get paid, there's an amount of tax taken out before you see it. The employer takes out an amount of tax and pays it directly to the tax office. In countries like Australia, there's a requirement that most industries must provide at least 9% of your wage for a pension fund that's available to you on your retirement. Now, many of you might not be thinking of retiring anytime soon, but it is it's a kind of a forced saving for many governments. Some of you will also be required to pay trade union fees, health insurance and things like that. So what happens? Well, what happens when you get paid is that the company will debit salaries and wage expense, or salaries or wage expense, something like that. They will pay you what you receive, which is a credit to cash, and they will recognise a liability for the balance. And the liability in Australia, the system is called pay-as-you-go. Right, or PAYG tax. The company is withholding it and they will remit it or send it off to the Australian Taxation Office at certain times in the year. Okay? When that occurs, it's simply a case of, as is the case with paying any other liability, debiting the liability and crediting the cash. These journal entries will get a little bit more complicated when you opt to pay for things. Like, for instance, what that doesn't show is when the company pays superannuation. So if the company pays superannuation, and let's say it's 10% of your wage,
So the salaries and wage would be 100. Superannuation would be 10% of that. That would be withheld. That would be recognised as an expense and a matching liability, because the company would then have to pay it on your behalf. Okay? Other discretionary payments, I mean, some of you will get jobs where you salary sacrifice a laptop or gym membership or something like that. They all get accounted for in a similar way. Okay. What about non-current liabilities? Non-current liabilities. So these are, liabilities due after 1 year. Typical forms include bank loans and different sorts of notes. And I want to talk to you about notes, and then I'll come back to loans. All right? So debentures are notes that are subject to a charge over the issuer's asset, the general charge over the issuer's assets. You might also see unsecured notes issued as well. So let's explore those a little bit. So why would you choose to issue debt, in terms of long-term notes versus equity? Let me show you. So one thing, if you seek to finance more of your assets by debt, then your control is not going to be affected. So if you're an entrepreneur, you form your own business, you all of a sudden, you need a capital injection. You might issue some shares, you might issue some shares to some friendly parties. If that exhausts and you need further funding, one issue close to your heart may well be your ability to maintain control of the company. If you issue debt, typically debt holders don't have a voting right. Major banks and major credit providers might get a seat, or might have a non-voting seat on your board, for example, but they won't typically have decision-making power. So your control is not affected. If you issue debt, then the interest payments, or as in if you borrow, the interest payments on that debt are tax deductible. Whereas if you pay dividends, the dividends are not tax deductible. All right? And earnings per share and return on equity might be higher. So let me show you. And this again is a slide at the back of your pack. I just want you to really, a little bit of clear thinking here. So what we've got, I've set up a really simple example for you. So we've got two companies that are otherwise identical, or that are identical, other than Company B has a different financing structure. Okay? So they've got identical assets. Their profit before interest is identical. Let's have a look what happens. So all I've done is I've varied the total liabilities of one company. Right? So its assets are financed 50% by equity and 50% by borrowings. I picked some nice round figures, and I know it's a long time since interest rates have been 15%. But if interest rates are 15%, then interest for Company B is $75,000, giving a profit after interest of $225, and if tax is 30 cents in the dollar, profit after tax of $157.5 versus $210. Have a look what happens when you calculate a return on equity. The lower profit for Company A, the higher profit for Company A, but given equity is $1 million, the return on equity is lower than for Company B. The profit for Company B is lower, but return on equity is higher because they finance more of their assets through debt rather than equity. Okay? So how this happens, there's one situation where this can happen, right? Where the return on assets that you get, so the return on assets that you get is higher than the cost of borrowing. Every additional dollar you borrow will increase return on equity. So return on assets here, $300,000 on $1 million, so 30%, right? The cost of borrowing is 15%. So of course, so that tells you that if you get one more dollar in of borrowing, you can turn that into $1.30. And all it's going to do is cost you 15 cents to get that dollar. So you're going to be better off. You're going to make 15 cents net for every dollar extra you borrow. If you do these figures again and you put interest at 15% and the return on assets of 12%, it won't work. Because you'd be borrowing, you borrow an extra dollar and it costs you 15 cents to get that extra dollar in interest, and you're only generating 12 cents return. It doesn't work. But where the return on assets is greater than the cost of borrowing, this will work. So imagine already, if you're looking at a company and a company says to you, or a company management says to you, we've earned more return on equity, we've generated higher return on equity this year, and you are able to tell whether that's because they borrowed more or whether they're fundamentally operating more effectively, all of a sudden you're pretty advanced in terms of your sophistication in analysing the company. So equally, if you are held, if you ever witness, or if you're ever held responsible, at least in part, for achieving an earnings per share figure or a return on equity figure, all of a sudden the incentive's created for you to borrow more money rather than issue more shares. Right? Because the same argument will go, and in fact more plainly, will apply to earnings per share. You earn the same dollar, you earn more profit, without issuing additional shares, your earnings per share is going to go up. Okay? Of course, there are disadvantages as well. Companies typically locked into fixed payments. These must be made regardless of the profit and the cash that you're generating. Principal must be paid at maturity. Now, as we've talked about already, and as I'll mention a little bit later on as well, business loans might actually be interest only. So that might actually be quite a cash responsible or a cash conservative kind of method of getting finance. So, you know, with an interest only loan, if you're in business, there's significantly less incentive to get a principal and interest loan, right? Because the interest is tax deductible. And if you've got an interest-only loan, you can conserve your cash and invest it elsewhere. So the major disadvantage of debt financing is the commitment to have to pay interest on a regular basis. At the same time, you balance that off against some of the advantages that I just chatted to you about in terms of maintaining control and things like that. I'll also encourage you to look a little bit more at the section in the book on debentures. So one probably most common form of long-term financing a company will adopt is through long-term debentures. Page 543 to 545 or thereabouts. There's a little bit of terminology there. Just know that debentures are a smaller denomination form of debt. So you might purchase a debenture of, 6 or 10 debentures in a company, and they might be for $1,000 each, for example. That $1,000, the face value of that might mean if you buy 6 of them or 10 of them and they're for $1,000 each, in 5 years' time you get $10,000 back from the company. Okay? There'll be a specified interest rate, and away you go. Companies will be able to issue standard debentures, 1,000 at 5%, or $500 at 10%, whatever it may be. Companies like to do that because they're generally quite a lower form of interest rate that they will pay. Their companies are less likely to have to give up security on a particular asset. I'll talk more about that in a minute. So they're quite an effective form of finance for many companies, quite convenient and not as restrictive, if you like. There's a bit of terminology though. The face value of the note is the amount due at maturity. So, if they're this is a $10,000 debenture or $1,000, etc. Depending on the standard content of the debentures, if they're $1,000 at 5% and the interest rate is only 2%, or the interest rate is 15%, the company might be compelled to issue them at a discount or a premium. Because if you issue a finance instrument at 5% and the current interest rate is 10%, then no one's going to use it. No one's going to find it attractive. So the way in which you balance that is that you issue it at 5%, but you issue it at a discount. Right?
So there's other terminology there, but I would encourage you to read that. All right? So, I guess to close that point off, again, while these are standard financing mechanisms, so long-term debentures, standard financing, so they're set denominations, set interest rates, etc., the price at which they will be issued by a company will vary according to the market rates of interest. So companies will be compelled to issue them at a discount or not, at a premium or not, or at par, depending on what the market rate of the interest is compared to the contract or the formal rate attached to the debenture. All right. The other, I guess, more standard or more probably familiar type of non-current liability to you is a loan payable by instalment. This differs from debentures in a couple of ways. So one is that you'll get a loan that's payable by instalment from one provider, whereas if you raise the same amount of money from a debenture issue, you might have to have, you might be beholden to, say, 1,000 people or 10,000 people. So if you issue debentures, you have a lot of smaller liability providers, and they have less restrictions, or they aren't able to take charge or security over one of your assets. Whereas if you go to the bank and you ask for the same amount of borrowings, the bank's going to say, "You beauty, give me some security over a large valuable asset, and we're going to restrict how you're going to use that asset." So for various reasons, many companies will opt for debenture issues rather than borrowing by way of something like a mortgage. The problem with a mortgage is that if you can't pay your loan, the mortgage provider has in the contract the ability to be able to seize the asset and sell it and take the amount that you owe them and give you the balance if there is any. Sometimes there's not. And the relevance for us in terms of recording is that each mortgage payment typically consists of interest and a reduction of the liability. Again, though, some loans may be interest only. But where there is a reduction in the principal and the interest, then it's really just a case of kind of setting up an Excel spreadsheet or downloading one from the internet where you just have to, put in something like the beginning balance and calculate the interest rate. You can compile these things fairly easily. So on a mortgage of $5,000, or mortgage payment $5,000, opening balance of $106,220. This is the example from the textbook, right? And we've got 12%. So interest rate is 12% times the beginning balance. $5,000 payment, you take away the interest from the payment, and the reduction of principal is the balance. Closing balance is opening balance, take off reduction of principal. Couple of key things about something like this. And you guys are really kind of very bright group anyway, and you're probably all over this, but let me point out a couple of things to you. Note that the composition of each payment changes as more is paid off the loan. It's pretty standard, right? If, however, you were paying an interest-only loan, then you'd be looking at that principal not changing for the life of the loan, and you simply paying the interest. In which case, the interest payment would go to 1,062, and that would be the case all the way through. That's fine. Look at how much cash you would save. Right? 1,062. So instead of $1, 2, 3, 5, 6, 7, 8, $40,000, you're paying about $10,000. So then the calculation becomes, what could you do with the extra $40,000 or $30,000 over the life of the loan? All right, so that's the trade-off between an interest-only loan and having the amount ready for having to pay the 106 at the end of the period, or being able to pay, chunks off it like this, and paying the principal and interest as you go. As you go further down the loan, the portion of each $5,000 lot that constitutes interest and the portion that constitutes principal reduces. The more you pay off, the more you reduce the principal, which is the same reason why people will say to you, "Oh, I paid off my mortgage in 20 years or 15 years quicker." The only way that they're most likely to have done that is just to pay it more often. All right. So the journal entries that you would record for something like that, so if you're talking about 31st of January 2013, interest expense 1,062, reduction of principal 3938. There we go there. Debit the loan payable 3938, debit interest expense 1062, and credit cash at bank 5,000. Okay. In terms of classification, a little bit of clear thinking, I guess. If we've got an extended period like here, so we've got 31st of January, 31st of January 2014, right? There's a portion as at the 31st of March 2013, for example, the next 12 payments will all be current, and the remainder of those payments will be non-current. Okay. So if we give you a question in the exam that indicates whether that the loan is interest only, it's all non-current, because it will be interest only for a period of 5 years or 6 years or 10 years. If we give you an indication that it is principal and interest loan, then pick a portion, the portion that's due in the next 12 months will be current, and the rest of the loan will be non-current. In this case, as at 31st of March 2013, the amount outstanding is 94,288, 42,833 of which is non-current, and the remainder is current. And there it is there. All right, so there's your 94,288, and there's the breakdown. Okay? All right. How are we going? I think we're on track. So a couple of different types of liabilities that I want to share with you. One is a lease. Leases are quite a common form of finance. It involves basically a rental agreement between a lessee, i.e. the person paying for the asset, and the lessor, the person who originally owns the asset and gives it over to someone else to use. All right, so it's a common form. A lot of airlines actually lease their aeroplanes, for example. So these are big, these are often really significant transactions undertaken. So two general levels of lease: operating lease and a finance lease. There's moves underway to reduce the classification judgment that preparers of financial reports have when classifying leases. But at the moment, organisations can classify a lease as an operating lease or a finance lease. Significance is this: operating leases are simple rental agreements. So you get hold of an asset, you can use it, you pay the original owner for the use of the asset. When you pay for the use of that asset, it's a debit, lease, expense and credit cash. Just like you're renting, your office rent or your house or your car or something like that. Okay? When it's a finance lease, by definition, the finance lease is more substantial, both in terms of dollar amount and the length of the lease relative to the length of the life of the asset. So a finance lease it's a classification used to capture those situations where it's effectively a long-term purchase. And accounting standard setters have long been battling away to try and identify and capture those situations, because if you are purchasing an asset long-term, you should account for it as though you're purchasing it long-term. That means bring into your accounts both an asset and a liability. And you might go, oh well, so what? The advantages of doing so. Why would you lease an asset rather than buy it? Well, there's a couple of really clear and obvious ones, I guess. Provides you with the ability to access new assets for little or no deposit. Now, some of you are going to encounter this. Some of you may already encounter it with regards to a car. If you lease a car, if you're looking to buy a car, some of you will lease it by way of salary sacrifice. We can talk about the actual salary sacrifice offline. But you don't have to pay $75,000 or $50,000 or $100,000 for a car. You can simply sign on, and all of a sudden money gets sucked out of your wage each fortnight or each month. It's great, right? You don't have to come up with a dirty big deposit.
At the same time, though, they are a drain on your cash. You reduce the risk of obsolescence. At the end of the lease term, you can turn over your car or turn over your machine or your computer and get another one. Right? Who doesn't want that? Who doesn't want a new toy after every 3 to 5 years? You reduce the risk that you're going to be stuck with a machine or a computer or some sort of technology that becomes obsolete. Okay? And depending on the structure of the lease, if you are able to generate or if you are able to form a lease that is an operating lease, you don't have to account for the asset and the liability on your books. And I'll come back to the significance of that in a little bit. So again, classification between an operating lease and a finance lease. And the terminology that's used is that it depends on the transfer of the risks and ownership, the risks and rewards of ownership. If you are absorbing all the risks and rewards of owning the asset as if you owned it, even though you might only be leasing it, then you should account for it as if you owned it. That's the kind of principles-based criteria that the accounting standards adopt. Now, while there's technical, quantitative tests that the standard setters implement, that's the kind of catch-all type of requirement that's in place. Okay. I know this is not going to translate to good sound recording, but I'm about to have a drink. Okay. So what happens? Remember, we're able to do this. Now, some of you might be looking at that and thinking, why on earth would we have to, as a lessee, take into account an asset onto our books when we don't own it? Remember the definition of an asset. We don't need to own it in order for it to be an asset in our books. We just need to control it. Now, if you have an asset in your premises, you are the only one that can use it. You house it at night, you're responsible for its upkeep and its maintenance and things like that. It probably looks, for all intents and purposes, like you have all the risks and benefits and rewards of owning the asset. All right, so let's have a look. So we've got a finance lease. The value of the asset is $50,000. It's a 4-year term and we've got 10% interest. So how does it look? All right, so the lessee. So we're getting the asset from someone else. And if it's a finance lease, we have to recognise straight away a leased asset and a lease liability. $50,000. And you go, big deal. Well, where our debt to assets ratio is less than 1, okay? And that's going to be almost all cases, right? Liabilities should be less than assets. So our debt to assets ratio is less than 1. If you then debit assets and credit liabilities for the same amount, your debt to assets ratio will go up. So you automatically appear more risky as a result of a finance lease classification. Straight away. Okay? Now, some of your borrowings, some of your loan terms or your mortgage contracts or things like that might have built into them what we call debt covenants. That means that if someone lends you money, they might have a requirement in their contract that you are not allowed to borrow, to have your debt to assets ratio go above a certain level. This might influence how you decide to classify your leases or how you structure your leases. Right? So if the asset is in the lessee's books, what does that mean? Doesn't that mean it's double counted because it'll already be in the lessor's books? Well, the lessor would credit the leased asset, taking it out of their books, and debit a lease receivable or lease rights receivable, something like that. This is all in the text, guys. I'm seeing a lot of phones come out. Oh, photo. This is all in the text. Okay? I'm more concerned with you understanding what I'm explaining to you. Seriously. So it doesn't mean that the asset appears in both companies' books at the same time because they've credited the leased asset here. What they have done is they've recognised the lease receivable, the amount receivable under the lease, so the $50,000. Okay? Then what happens? Well, I've done a fairly basic lease schedule here. Well, I haven't done it. Okay, it's from the text. Lease payment, interest rate, principal reduction, balance, we've got the whole bit here. Okay?
So if it is paid off entirely over 5 years, right? We start off on the 1st of 7th, 2016. Right? Then each payment, so the payment, the very first payment would be recorded by the lessor as debit cash, credit lease receivable, which is the principal reduction. We know the interest is 10%, so the interest gets calculated first and the remainder is the principal reduction. And the balance, which is interest, gets credited to interest revenue. Right? So the lessor is reducing the lease receivable. After 1 year, there's less lease receivable. In terms of the lessee's books, 2 things need to occur. One, as each payment is made, the lease liability gets reduced. Right? Remember a couple of slides ago, we took into our books a lease liability of $50,000. As each payment is made, the lease liability reduces by this amount here. Okay? You debit interest expense for the $5,000 to match the $5,000 interest revenue that the company, the lessor, recorded, and you credit cash for $15,773. The only thing that's missing, the only thing that we haven't accounted for, is the lease asset, the lease amortisation. You know, the reduction in the lease rights receivable, if you like. Remember the asset that the lessee took onto their books, the lease receivable? Their rights to receive the lease over time. Okay? All right, so what we've got to do, so that payment, where is it? That payment there will reduce the lease receivable. We've also got to record amortisation of the rights under the lease of $12,500. All right, debit lease amortisation expense, credit accumulated amortisation. Both the leased asset, the lease receivable, and the lease liability and the leased asset for in the lessee's books will reduce over time. So in terms of, at the end of the first year, the lessee will have the leased asset in their books of 50, less accumulated amortisation of 12,500. And the liability will reduce by the amount. So the lease liability and the leased asset will be at different levels over the period of the lease, because the interest rate doesn't accord to 12.5%, which is the same. It doesn't accord to 25%, which is the same as the amortisation period. At the end of the amortisation period, they will both be equal. Okay. So that's leases. So the main messages out of leasing is, I guess, a couple of things. For example, what are the different types of leases? Why would a company select leases as a mechanism for purchase or for acquiring some assets? What are the mechanics of recording the different types of leases? And I've focused on finance leases because they are clearly more, I guess, complex than recording under operating leases. Okay. 2 other categories of liability. So basically we'll go 2 other categories of liabilities. I'll show you a couple of ratios to use to analyse liabilities, and then we might have a short break, and then we'll finish off with equities, and then we'll be done by about 7-ish. Okay? So 2 other categories of liabilities, provisions and contingent liabilities. So I mention these for one reason only, and that is that there's something slightly different about each of those relative to other types of liabilities. So provisions are liabilities, and liabilities, yes, but they're liabilities for which there exists a little bit of uncertainty about the timing and or the amount. All right? So a warranty is a good example. So where we go and buy a television or a fridge or something like that, and we have a 1-year warranty or a 2-year warranty, etc. Many companies will actually automatically give you a certain level of warranty
and you pay extra to extend it. Okay? Our warranty is an obligation by whoever's providing it to provide you with after-sales service, i.e. replace something that's gone wrong or fix it for no cost, etc. All right? Question is, what happens when that occurs? Well, at the end of a period, a company will typically make an adjusting journal entry to provide for the amount of warranties that they think they will be up for. That is along the same lines as raising a provision for doubtful debts, and that is, over time you get a feel for how much, with experience, you get a feel for how much you're likely to be up for. Debit the expense, credit the provision. Right? Exactly the same way as raising a provision for doubtful debts. When some sort of action is required to replace goods or, to undertake some repairs or something like that, debit the provision and credit inventory, or if some sort of refund, credit cash. Okay? But we use the warranty provision in much the same way as we use we use it to sort of value the potential amount that we think we're going to be up for, to repair or replace or undergo additional activities that we've committed to do so under the contract of sale. I mean, you might say, well, why don't we just sell better stuff? The likelihood of you getting away with selling TVs or white goods or electronics or computers, etc., and having nothing go wrong is fairly remote. So most companies will have a warranty provision or a warranty policy that will lead to a fairly specific level of provision. Mind you, though, that does remain an area over which there is significant judgment. And if you wanted to increase your profit in any particular year, all you do is you provide for less warranties. Now, I've given an example of $200,000 here. It's a really small warranty provision, really, for any company of any size. So, needless to say, when the auditors come in, they'll spend more time looking at things like provisions, contingent liabilities, and things like that. Why? Because if we've got a lease, and things like the classification of leases, if we've got a mortgage, we know who the mortgage is with, we can verify the terms, we can verify its classification. That's the easy bit. It's the ones where more judgment is required that require, that present the company with a little bit more risk. What about contingencies? Now, these often will fly under the radar. They're not immediate liabilities. We've existed so far in the semester talking about liabilities being a present obligation. And yet all of a sudden I'm talking to you about contingent liabilities. So these are liabilities, or they will become liabilities if a specific event or transaction or something happens. Why I mention these is because these have been the cause of a number of companies going into bankruptcy in the past. Common types of contingent liabilities include things like an unresolved legal action. So we are being sued by someone. Right? We don't quite know whether we'll be up for anything. Why? Because we've got to lose first, and then we've got to have damages awarded against us second. So a liability doesn't go in the balance sheet on the face value of on the face of the balance sheet because we haven't got a present obligation. We can't measure it. But they will be required. The company will be required to disclose it by way of a note. It is crucial when you are looking at a balance sheet with a view to transacting with a company, or working for a company, or whatever you're going to do with a company, to have a bit of a dig around to see if they've got any contingent liabilities. See what happens? So the other thing to look at, right, is whether or not the company has provided any third-party guarantees. Now, this is a bit of an odd one. This is like you saying to a sibling, you go off and you operate however you want to operate, and I will agree. This is like a parent thing, right? I will agree to cover the debts that you incur. Okay? So if you go off and you borrow money and you default on the loan, I will sign a document to guarantee the debts. Now, you don't see this all that often, but it is relatively common for companies within a group. So a parent company might guarantee the loans of one of the subsidiary companies. Or they're going to be related in some. Obviously, you don't do this with some, random company, right? What it does mean, though, is that there's an element of risk involved in dealing with the company if there's another company out there somewhere that might incur debts and then fall on the company that you're dealing with. Third-party guarantee, watch out for it. It has brought a number of companies undone in the past. But these are contingent liabilities. They're not actual liabilities, so you'll only find these in the notes. There'll be a note called contingencies or something like that in the notes. Okay, so how do we wrap up liabilities? Well, I'll just share with you a couple of things and then we'll have 5 minutes and then we'll have a 5-minute break. So, having recorded liabilities, the next task is to analyse them. And analysing your debt position or the extent of liabilities that you've got or the relationship really involves you coming to grips with the relationship between equity, liabilities and assets. And you can look at these in a number of different ways. But the way to analyse the financial position or the funding of a company is to break it down. One way to think about this is to break it down into short-term and long-term. For you to be comfortable dealing with a company, you need to be equally comfortable or somewhat comfortable with their ability to pay their debts in the short term as well as their long-term financial position or security. All right? So short-term, or otherwise known as liquidity, typically involves calculations like working capital, current ratio, quick assets ratio. Now, we've discussed the first two, working capital and current ratio, so I just want to talk about the quick asset ratio. All right, so if you're interested, there's a working capital ratio for Telstra, and there's the current ratio. See, basically what the working capital and the current ratio are just variations of the same thing, the relationship between current assets and current liabilities. Wherever you've got a situation where current liabilities is greater than current assets, you'll have negative working capital. Now, this is part of my problem, or not my problem, but part of the reason why I would encourage you to think about working capital as just a sort of a ballpark calculation anyway, is that a company like the Telstra Group has got negative working capital of $734 million in 2012, but it's not going anywhere, right? It's a pretty sturdy, pretty solid company that's got access and control over a vital piece of infrastructure that's probably going to guarantee at least a portion of its profitability in the short to medium term. And yet it shows up as negative working capital here. And you can kind of almost go, oh, well, it'd be nice if it was positive, but there's no real deep significance to it. Current assets, or the current ratio, is typically a more robust calculation. As I've talked to you about in the past, I would encourage you to guard against having any sort of benchmark requirements. You read some textbooks and it'll say, oh, this must be above 1 to 1. Where you've got 0.93 to 1 in Telstra in 2012, the company's still okay. It's still around today. Right? So the earth is not going to fall in if the current ratio falls below 1 to 1. It still does depend on the quality of your current assets anyway. I mean, we can have all the current assets in the world in our books, but if if we can't convert our assets to cash, or if we can't sell our inventory or collect our debtors, then this might be misleading anyway. Okay? What I wanted to show you, though, is the quick asset ratio, or the quick ratio. All this is we're going from the general, being the current ratio, to the more specific. And I've showed you some cash flow related ratios in the past, and these kind of get to something pretty similar to the quick ratio. So the quick ratio is trying to estimate a more immediate ability to pay your debts in the short term. So can we isolate more liquid current assets and figure out our immediate ability to be able to pay our liabilities? Well, you can think about it in a couple of ways. So cash and other short-term notes and net receivables divided by current liabilities. Or another common way of calculating is simply just take current assets and take away the least liquid current asset, typically being inventory.
So you have receivables and your short-term investments and things like that, and think about how easily and to what extent that, those quick assets are enough to cover your current liabilities. Don't panic if it's less than one to one, because all your current liabilities aren't going to be due on the same day anyway. But it does give you some sort of indication. I mean, do this for a couple of periods in a row and you get some sort of trend, or you might get some sort of trend as to how the company is tracking, whether it's changing its shape in terms of its ability to pay its short-term debts. Be under no doubt. Don't think that I'm blowing these short-term ratios off though, because a company's ability to be able to pay its debts in the short term is critical. There's also some longer-term solvency or longer-term financial statement ratios that we typically calculate to understand debt. The longer-term ones, where we use total liabilities and total assets, we refer to them as solvency. So you can use debt to assets, assets to equity, or debt to equity. All three of them will tell you the same thing. So the debt to assets ratio, for example, tells you the extent to which our assets are financed by our liabilities. So for Telstra, for example, you don't see too much change over time, although 3% change in 1 year, 2012 to 2013, is quite significant, actually. What that tells you is that in 2013, 33% of Telstra's assets is financed by equity, and 67% is financed by debt. Okay? Again, the higher the ratio of this, on the surface of it, the more risk, but at the same time, the next place you would go if you were analysing a company with higher debt to assets ratio is you calculate times interest earned, which we're going to do in a minute, and then you go to the cash flow statement to make sure that they're generating enough cash to be able to service the debt as they go. And here's the times interest earned here. So this one is calculating your financial security in terms of the static relationship between your liabilities and your assets. This one is really measuring or estimating the company's ability to be able to generate enough profits, which will ultimately lead to enough cash to pay your interest expense. You want to see this high enough for there to be enough kind of cushion, if you like. Enough can go wrong, interest rates can go up, profit can come down a little bit, and you still have enough latitude, or you still have enough capacity to be able to pay your interest. If this is exceedingly high, it may be an indicator that you're actually not borrowing enough. So, for example, if we typically work with a range of companies to try and help them understand their debt and their borrowing and things like that, and wherever you see a company with significantly lower than this debt to assets ratio, the conversation immediately or ultimately will start zeroing in on, are you borrowing enough? Are you foregoing potential profits by not borrowing? Because I've just shown you that companies can actually leverage up their profits where they borrow more money. Okay? That brings us to the second part. So it might be a good place there to have a break for 5 minutes or so, and then we'll come back and we've got about half an hour to go. So make it 6:33, literally 5 minutes if possible. Okay? All right. 5 minutes goes quick. Okay, hardly time to start a conversation. Some of you, however, it is time to fall asleep, so wakey, wakey. All right. I had a few questions about the assignment. So I have purposely left this as broad as possible. Now, a lot of you are looking at me with pained looks on your face, and I get it. I really do. I understand this is a challenging assignment on the one hand. On the other hand, it's a great opportunity because, and I get paid for saying this, but it's actually true. It's a great opportunity because there is no secret source of data that you need to go to prove this.
right? I don't have a preconceived idea as to whether this game should be changed or not. I don't. I don't care what time the grand final is, right? I care that you guys do a good job. That's different, right? So let me give you another example. So whenever a company goes to make a big decision, right? We're going to buy new premises. We're going to expand overseas. We're going to buy. We're going to bid for the rights to host, to televise the next Olympic Games, whatever it is. Someone in that organisation has to put their head, stick their neck out, right, and come up with some arguments, come up with some data to justify why they should do it. And that data might be, well, let's take what we know to be the case. And even if we assume more people will watch, or even if we assume that Qantas want to buy an A380 Airbus, why would you spend $250 million on an A380 Airbus? If you focus on the cost, it's a lot of money. But if you go, well, these things, I don't know how many of you have ridden in one. They're huge, right? And they're really fancy and they're very cool, right? But that's not going to get the job done. In terms of a capital budgeting committee, what you need to go in is you need to say, well, these things cost this amount of money. The potential upside is 800 seaters. Even if they're 50% full, even if they're 80% full, what would it look like, right? There is no secret source of data that will prove this when the grand final should be played. If there was, it wouldn't be a debate. All right? So what I'm encouraging you to do is have the freedom and have the confidence to explore alternative sources of data to try and support your arguments. Okay? I'm not going to put a big cross on your work if you classify something, if you make an assumption that this might result in a 10% increase on the current situation, and I think it might be 15%. I don't care. Right? I'm looking for you to demonstrate some clarity of thought as to how you might put together the argument. It's more about the process. Okay? So if you think that I'm trying to get all passionate about this and encourage you to kind of feel free, play to your strengths, you're here because you're bright. You bring some different perspectives. Use them. It's completely legitimate to ask me about structure and things like that. I get it. Absolutely fine. Don't get hung up on structure, though. That's all I'm pleading with you, not to get hung up on the structure. I want you to set it out well. I want you to kind of adopt some sort of, business case kind of formality level of reporting and reference things appropriately. Other than that, bring it on. Show us what you've got, right? And I know this is kind of motherhood stuff, and you think, oh, that's not all that helpful. You will see when you get them back, you will see a lot of comments on them, regardless of whether they are 15 out of 15 or less than 15 out of 15. You will get a lot of comments on them, but they will be constructive. There will not be a comment that is not constructive unless you write something that's really bad. I'm sure you're not going to do that. There's a bit of humour there, but I know it was not well delivered, right? So if you think I'm trying to give you confidence to have some faith and to explore what you can do, I am. That's exactly what I'm trying to do. Okay? Does that work? Did that work? Yeah, sort of. Yeah, no, okay. So let's make a run till about 7 o'clock, a little bit later, and we'll see how we go. Let me have one more drink first. All right. So the last part. All right. I just wanted to explore the implications of the other side of the funding coin, if you like. And that is, explore what happens when a company is formed and they choose to fund their operations through equity rather than debt. So, in doing so, that necessarily draws us towards a corporate form of organisation, in particular corporations or companies. All right? So, let's just explore this for a minute. So, a corporation created by law. This is not a business law or company law lecture. But what is relevant to us? Someone's got a message, right?
checking it too. All right. What is relevant to us is that a company is a person created by law effectively. So a company can own things and borrow money and earn profits and employ people and things like that, right? Companies are the most common form of, I guess, vehicle. The other thing that makes them particularly sort of relevant to us is some of these things. For example, the limited liability of shareholders. Companies have a continuous life and they've got a greater ability to acquire capital. So the limited liability of shareholders just means that if you form a business and it is a sole proprietor, you form the business by yourself, then the sole proprietorship is not a company in its own right. It's not a separate legal entity in its own right, and you end up guaranteeing effectively the debts of the company, of the business. And so if the business goes into bankruptcy, your personal assets are in potential danger. You compare that with a company where your personal liability is limited to the extent of your investment. So if you tip in $50,000 and you buy shares in your own company, then the most you can lose if your company goes into bankruptcy is the $50,000. There is a couple of opportunities for regulators and forensic accountants and other creditors to claw back money, but what you'll find is a lot of CEOs of companies and entrepreneurs will actually divest themselves of all their personal assets to protect, just to make sure that no one can have access to their own personal assets. I'm being a bit simplistic there, but that's quite often what happens. When a company is formed, I'm going through some of the sort of intro stuff fairly quickly. When a company is formed, it's allocated an Australian business number, Australian company number. It adopts a constitution. So the rules of engagement, if you like, and it'll have information. So some of you might have companies of your own. They might be private companies or they might be trust companies, etc. Companies will have a constitution setting the rules of their internal management. They'll have things like where the registered officers are, who the accountants are, where they have to meet, who the directors are, etc., etc. They will also have information about the extent to which the company can issue shares. All right? And the company will be registered as a public company or a large proprietary company, etc. And that will constitute how easily the company can acquire capital, or in other words, can it go to the market and do it publicly? Companies are owned by their shareholders, and the different companies might have different classes of shareholders, typically differentiated as ordinary shares or preference shares. Now, as the name suggests, ordinary shares are the normal or the most common form of shareholding, and they're the sorts of shareholdings that we know and have become familiar with so far. Right? For example, you typically have the right to vote, you share in a company's profit, you get dividends, etc. Companies might also offer preference shares, and these are a little bit different. So on the surface of it, and this is a link to one of the last slides in your pack. So there's no big deal other than trying to absorb what I'm showing you now. So preference shares, they've got some sort of preference or some sort of priority treatment over and above ordinary shares. It might be, for example, that they receive preference dividends, and that is most commonly the case, that first one. So if a company's got $1 million available for paying dividends, all the preference shareholders get their dividend first, and then whatever's left over is typically made available for ordinary shareholder dividends. It's usually a fixed dividend, so you might get a preference share and it might be 8%. So each year you get an 8% return. They might be cumulative, they might be non-cumulative, but cumulative means that if a company doesn't pay its dividend in any particular year, they'll pay last year's dividend and then next year's dividend. If they don't pay a dividend in any particular year, when it comes time the following year to pay dividend, they'll make up last year's dividend, they'll pay the current year's dividend, and then whatever's left over will be made available for ordinary shareholders
They might also be convertible to ordinary shares, or the company might agree to pay them back at the end of a particular period. So you might actually be able to purchase preference shares that are redeemable. So you might get them you might have them for 5 years, at which time the company agrees to buy them back. So if you think about it on those bases, there is a reason to identify preference shares as having some characteristics that you typically associate with liabilities. Right? Remember, the thing that, or one of the things that typically sets apart liabilities and ordinary shares is that you have ordinary shares until you sell them. Whereas if your preference shares are redeemable, all of a sudden you have them for a fixed term. And wait on, one of the things that sets apart equity and liabilities has gone away. Right? Preference shares might be, they attract a cumulative, a guaranteed dividend rate. Right? So on the surface of it, one of the differences between shares and debt is that regular payments to shareholders, i.e. dividends, are discretionary. But under preference shares, these dividends are no longer discretionary. So I guess all I'm saying is that preference shares kind of sit more towards the middle in terms of the differences between equity and liabilities. All right. So when a company goes to issue a share or issue shares, they usually, obviously the goal is to generate some cash. So you get your business to a certain level, you want an injection of cash. You decide you're going to do it via a share issue, you've borrowed some money, that's all okay, you've made the strategic decision to issue it. You must have an ability to do so under your constitution, and then you make some sort of decision about how much you're going to issue by way of how many shares, at what price they're going to be issued, and whether it's going to be underwritten. Underwritten means basically guaranteed by a bank or a lending institution of some sort. So, you might hear private placement, you might hear public issue. If it's a public issue, you write to everyone, you release a public prospectus, which is basically a forward-looking set of financial statements. This is who we are, this is why we need the money, this is what we're going to do with it, this is the budgeted financial statements. This is about our corporate governance, etc., etc. Companies might also issue private placements, issuing shares to investors, known investors, so institutional investors. So you typically do that in the same ratio as your existing holdings, right? Because if you are a shareholder and then all of a sudden the company goes and issues more shares to others, then you lose, your proportional ownership reduces. So you see public issues occurring all the time. You see private placements occurring perhaps less frequently. All right, so what happens? So when a company does issue shares by way of a public issue, what they're trying to do is they're trying to basically increase cash and increase contributed capital or share capital. What they do though, and you'll see this from time to time, is that where there is a prospectus involved, there'll be an opportunity to apply for shares, and they might be, a decision might be made on the 30th of June, but all applications are due by the 31st of March, for example. So on receipt of the application, the money is held in trust, which just means it's not the company's money yet, because they haven't decided to issue the shares. Credit an application account. At the point at which the shares are issued, you debit the application account, you credit share capital. Job done. Shares issued, companies, people get written to notifying them that they've been successful, they get a share certificate or some sort of acknowledgement of holding, and then they're on the company's register. That's a pretty basic example, and there are other examples or other discussion in the textbook that I'd refer you to in the chapter. Is basically the situation with shareholding or share issues is that companies don't go to the textbook and define the rights attached to a share when they construct a share issue. It might be though, if you've got shares, for example, that are $100 each or $50 each, it might be that
if you require them, if you require people to apply for lots of 100 or 200 of them, that might mean that the potential number of people that have got the economic kind of capital to be able to apply for shares reduces. So what a lot of companies do is that they will issue shares by way of payable by instalments. In other words, it might be a $100 share, it might be a $50 share, but you only need to pay $10 at the point of application and the rest to come later. So that's pretty common actually. So a lot of share issues are actually made by way of an amount due on application. Might be half, might be a third, something like that. And then amount by way of later. So it might be 2, 3, 4 months after initial issue. So there'll be some in the room that, one of the more recent sort of large-scale public issues in Australia that was very public was Telstra, the third tranche of Telstra. What was unique about something like, an issue like that was that the company actually issued shares and Telstra was under a little bit of public relations pressure at that point. And so they weren't travelling all that well. There was a little bit of argument about how good a firm Telstra was. So they constructed an issue whereby you applied for the shares and on part payment on application, once the shares were issued, you got the next dividend. So it made it all that much, just that little bit more attractive. And as a result, I think it's safe to say, as a result, the third tranche of Telstra was way oversubscribed. It was very popular. Right? So the point being that companies can construct different different conditions around the issue of shares. So if you're ever thinking about applying for shares in the near future, have a look at the prospectus, have a look at what you have to do under the prospectus. Because it may be that all of the amount for the share purchase is required up front, or it may be that the share purchase payments are required by instalment. All right. So just a couple of things to finish, I guess, and that is you might also see other companies engaging in other transactions. So there might be a bonus issue or a share split. So a share split, what happens? So don't panic. A company might write to you and say that we will issue a 2-for-1 share split. So for every share you've got, we're going to give you 2 more. And you think you're beauty. But what will happen is that the price, the market value will probably reduce by about half. Why would they do that? They're doing that for generally one reason and one reason only, is that they want to make their shares more accessible to more people. So as shareholders, we probably don't care, right? Because if you've got 100 shares at $10 and you all of a sudden get another 100 shares, but the price goes down to $5, economically you're no better or worse off. Okay? You might think that there's a potential upside because you've now got 200 times a small chance that there'll be a capital growth in the shares. The company likes it because all of a sudden more people will be able to start thinking about transacting for those shares, so they might bid the price up. So the company's happy. So you will see share splits happening for, from time to time. Doesn't affect the book value or the total equity of the company, right? But it does affect the amount of shares that the company will technically have on issue. Occasionally, the share price doesn't completely correct, in which case the share holders are better off. So CSL shares, a few years ago, they had a 3-for-1 share split. Share price fell from $100.80 to approximately $35. So if you took part in that, you're actually better off. Right? You're better off by about $4, which is, it's not huge, but there you go. The other common transaction that you will see for a company and its shares is dividends. Now, I won't go over that too much. I'll just make a couple of points. Why? Because we've already talked about dividends. So dividends are a distribution of profits. They are not an expense incurred in generating profit. That's all right. So companies will typically pay an interim dividend
and a final dividend. So the interim dividend, you'll see that in the annual reports, the interim dividend will be declared and paid in the same year. So if the company's year end is June, typically companies will pay dividends in March and September or thereabouts. Right? So if the company's year end is June, the interim dividend will be paid in March. If the year end is June, the final dividend will be declared in June and paid in September. All right? So to find out, and they're fairly standard dates when dividends might be paid. Companies can also, not only are dividends a distribution of profit, they are discretionary. While companies will get penalised if they've got a history of paying dividends and they all of a sudden drop their dividend rate or don't pay a dividend in a particular year, they will get penalised by the market. There's no question about that. Basic finance theory is that the price of a share is the present value of all the future cash flows that are going to come in as a consequence of owning that share. So shareholders make a judgment about the future dividend streams when they buy a share. And if something happens to change expectations about that dividend stream, the price should go down. Okay? That said, companies can vary dividend rates depending on the availability of profit, the availability of capital, and also they can choose to move to a share dividend or a cash dividend. So it's a really convenient way of managing your cash flow. When you issue shares, you need not necessarily pay dividends in cash all the time. I think we know, generally the entries to record when paying dividends. What I did want to do, though, is just finish with a really, really short discussion about a couple of ratios or a couple of ways you might think about analysing a company's performance with respect to its dividends. And the most common way is to look at something like the dividend payout ratio or the dividend yield. So the dividend payout ratio, for example, cash dividends divided by profit. The percentage of profit distributed by the company by way of cash dividends to ordinary shareholders. You can include share dividends in this if you wish. Companies might also, if you calculate dividend payout and you calculate return on equity, you get the proportion of profit available for payment of dividends, and then you get the actual payout ratio paid, so you get the opportunity, so you learn more about the company's policy with respect to paying dividends. So there's probably two or three or one or two more ratios that you might want to calculate, but if you are able to look at a company's dividend performance and calculate the dividend payout ratio, compare that to return on equity, you're going to get a reasonable sense of the company's willingness and openness to pay dividends over time. So that pretty much sums up what I wanted to chat to you about this week. Bear in mind, when I go through ratios like this, I reiterate that in the exam you will not need to memorise ratio formula. Right? I will give you, don't clap too much, because that just means I can ask you harder questions. Now, on a serious note though, I don't see any reason to test you on rote learning of ratio formula. I will either give you the ratios right? I will either give you the formula within the question, I will either give you the calculation, I'll do one of those two things. You will not need to rote learn these ratios. I might give you the dividend payout ratio result and formula and get you to analyse it, but I won't require you to memorise large amounts of formula at all. All right? Good news to finish. See you next week.